Welcome to ForexTV.com's PM Exchange. It's Tuesday, February 5th. I'm Remy Hoki. Today I'm joined by Peter Wadkins, Senior FX Analyst at Thomson Financial. Good afternoon, Peter.
Hello, Remy. How are you?
Good to have you on the show today.
Thank you for having me.
Well, in today's session, we're starting to see a slight shift in the Forex market. Euro-dollar hit a low today at 1.4623, and we saw U.S. equities plunge, but dollar-yen has been hovering around 107 in the afternoon session. So, Peter, if we could first start out by talking about what's supporting the U.S. dollar in today's session.
Okay, well, I think that what's happened is there's been a bit of a shift in people's evaluations of risk profiles. The European data this morning was much worse than people really anticipated, and it comes on the back of a month's worth of not very good data. Last week we had German retail sales down almost 7% year on year. For the whole Eurozone it was down 2% year on year, which is not a very positive sign. The PMIs and the ISMs are all much lower than people expected. And the Spanish ISM this morning was at a 9-year low. So I think people are concerned that the overall slowdown in global growth is going to catch up with the markets. When it was just isolated to the United States, they were comfortable with selling the dollar. But now the fact that they're seeing those signs in Europe developing has macro funds particularly very concerned.
Okay, Peter, while we're talking about the European currency, we have the ECB meeting coming up on Thursday with their rate announcement coming out in the morning session on Thursday. And there has been talk that the ECB might possibly hike this week. Peter, what do you think about that? And do you expect to see more upside for euro-dollar?
Okay, well, right off the bat, I think there's a little dichotomy in the markets. Foreign exchange traders themselves do not have a strong belief that the ECB is foolish enough to raise interest rates at a time when the growth numbers are moving diametrically the other way. I think that the money markets are more skittish and concerned about the euro hawks who keep drumming the second round inflation drumbeat and are afraid that because the ECB's singular purpose is to control inflation, that they've been forced into a corner. On balance, I don't really know anybody in the market really sincerely believes the ECB will raise, but it is a fear. And because it's a fear, it's part of why the stock markets dropped today. We've got another 2 days to get through before people can breathe a sigh of relief, and hopefully Mr. Trichet will give everybody a break.
Well, Peter, while we're looking at central banks overnight, the RBA hiked their interest rate by 25 basis points to 7%, and that had been widely priced in by the market, and there had been even talk about a 50 basis point hike. But in today's session, we saw that the Aussie pulled back below the US dollar under 90. And while we're seeing a decline in the CRB index, Baltic Dry index, fundamentally, what do you think is going to drive the Aussie going forward?
Well, I think your observations are right on, Remy. It's the commodity situation which is driving the market today, plus a little bit of profit taking. The buy the rumor, sell the fact. You're aware of that. So I think that people were shocked today to see the response in euro markets and the sharp drop in euro. Euro has been heavily correlated with gold and oil recently, and the fact that the euro markets showed explicit signs of slowing growth has finally got people in the energy market saying, well, how can we maintain close to record high levels in energy and gold markets if, in fact, global growth is going to be slowing?
Okay, and looking ahead on the data front, also on Thursday we have the BoE coming out with its rate announcement. So let's talk about what we can expect to see out of their rate decision and what your forecast is for their curling of their currency of sterling. Okay,
well, first of all, I think it's pretty heavily discounted that we're going to see a 25 basis point rate cut. Most people accept that. The Bank of England has been very dovish in their comments. Almost to a point where they've chastised the ECB for not recognising it should be adopting an easier policy earlier. I think that we will see the 25 basis points cut. I don't think they'll go 50 basis points because I think some of the data we saw this morning was a little stronger than people expected. So 25 BP with an easing bias is probably the outcome. With regard to the currency itself, I'm still somewhat bearish on sterling. I think that because they started their slowdown after the United States, and they've only started priming the pump, that they're probably going to see further declines in economic activity before they hit a bottom. And sterling at 210 was widely accepted as being vastly overpriced. Strangely enough, a lot of that pressure was taken in the euro sterling exchange rate, which went to multi-year highs, and I think that will be something that may change once we get a clearer view of what the ECB is doing.
Okay, so Peter, you've given us your fundamental analysis of the euro as well as the sterling, but if you could also tell us about your forecast for the euro as well as the sterling against the Japanese yen.
I'm very bearish on euro-yen. I think there are still huge euro-yen positions that build up across the globe, and probably some of the biggest positions across the globe are still in euro-yen. As much as we've seen a large adjustment in our exchange rate, I still think there's more to go. I think that Japanese investors particularly are going to be bringing back some of their investments from overseas. With that being the largest position out there, I think you're going to see that one adjust. With regard to sterling yen, similar situation. Sterling yen is going to decline, but that started declining 2 months ago. It hit a peak and then started to slide. So I think that they're ahead of the curve on that one. Have been trimming back positions. And so we probably will still see some further downside pressure, but it won't be as much as in euro-yen.
Okay, and Peter, last but not least, before we wrap it up, in the current environment, where do you see the most opportunities in the foreign exchange market?
Staying out of it? No. Personally, I feel that we are very close, if not already at a bottom in the dollar. I think that but against specific currency pairs. I think dollar Swiss is probably likely to go higher. I think sterling, seller of cable, seller of euro. Dollar yen, I think, is going to be in very much a trading range. I think the pressure is going to be downside still on Asian currencies to adjust because of the large trade surpluses. Aussie dollar is the one thing that stands out there that at some point, unbelievably, you still probably have to look for a level to buy it because the RBA is still on a tightening basis. Got another 25 BP to go at least, and commodity prices are still very high at the moment, and domestic growth is still strong. So until that tapers off, you're going to see the Aussie strong on the crosses, if not straight against the US.
Okay, Peter, thank you very much for coming on the show today.
Thank you for having me.
This has been your Forex News with Peter Wadkins from Thomson Financial. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks plunged in today's session with the Dow Jones Industrials down 370 points. This came after investors saw an unexpected contraction in the service sector. It was the Dow's biggest point drop since last August. Today's ISM non-manufacturing data raised concerns that the U.S. economy is entering a recession. The ISM non-manufacturing index fell to 41.9% last month, down from 54.4% in December. It was the largest one-month drop in the index's history. At the closing bell, the Dow Jones Industrial Average fell 370.03 points, or 2.93%, to close at 12,265.13. The tech-heavy NASDAQ lost 73.28, or 3.08%, ending at 2,309.57. And the S&P 500 fell 44.18, or 3.2%, closing at 1,336.64. In the fixed income market, U.S. Treasury bonds rallied as risk aversion saw investors moving to safe haven government debt. This came as the U.S. January ISM non-manufacturing index came in well below expectations. The benchmark 10-year Treasury note rose with its yield at 3.573%. The 30-year long bond surged with the yield at 4.337%, and the 2-year note gained with its yield at 1.935%. Taking a look at energy, NYMEX crude oil futures declined, ending the session below $89 a barrel. Today's weakness in ISM non-manufacturing data added to increased concerns about the U.S. economy. Energy demand could pull back, given the weakness in the latest economic data releases. March crude fell $1.61, ending at $88.41 a barrel on the New York Mercantile Exchange. Meanwhile, other petroleum prices also fell, with March heating oil down 3.68 cents, ending at $2.4465 a gallon. March gasoline futures fell by 4.7 cents, settling at $2.2647 a gallon. Meanwhile, March natural gas futures gained 7.3 cents, ending the session at $7.942 per million BTU. Over in the metals complex, gold futures saw a sharp decline, ending the session below $900 an ounce. Today, the U.S. dollar gained and the slower demand for the precious metal. April gold fell $19.10, settling at $890.30 an ounce on the COMEX division of the NYMEX. Other metals followed gold lower, with March silver down 43.5 cents, ending today's session at $16.345 an ounce. March copper fell 8.65 cents to $3.2120 a pound. This afternoon, we're joined by Derek Fry, head trader at ONF Futures and Options. He'll give us his commodities recap for the day.
I'll start with gold. We saw a strong pullback in gold below 900, partially on the backs of some rumors coming out of Europe about more than a quarter of a point rate hike. Highly doubt that, frankly, coming to fruition. So don't be surprised if you see a reaction back up on the back of the ECB announcement. But ultimately, we're still looking for downside follow-through in the gold market, at least a retest of 850 in the near term. Love to see a retest of 800 in the longer term, if at all possible. But frankly, that's a little bit too hard to call at this stage in the game. We're really, like I said, targeting a move to about 850. Let's see here. If silver at the same time also needs to have a significant correction, and we feel that that's in the making here. We did see a nice correction today, and we expect it to continue here in the near term. Of course, at the end of the week with the BoE and the ECB meeting, all bets are off. Through that meeting, you'll see lots of volatility. But on the backside of that meeting, I would expect next week to see continued downside follow-through in these metals and the euro and other related markets for that matter as well. Moving over to energy. Energy also had a strong pullback on the strength of the dollar today. Crude oil in particular, obviously. Crude oil needs to hold the line, preferably above 86, but at the very lowest above 85 to maintain current support levels. If those levels are taken out, then we could see a big kind of washout push down to 80 and possibly a dip below that. If it did actually push those levels, we would really be looking to buy long-term long positions on any dips to or below 80. Frankly, at this stage, really don't expect that to happen, but in the event that it does, that's what we'll be looking to do. But ultimately, like I said, look for 85, somewhere between 85 and 86 to hold the line here as we test those levels, well, frankly, probably tomorrow on the EIA data.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.